welcome to TheoTrade. This is Don Kaufman. Here we are. It's June 20th, 2018. You are watching the Theo Night video. First and foremost, well, we're going to start off with what I would kind of term a little bit more of a hardcore comparison chart. This happens to be none other than a four-way comparison of your major index products, which I'm going to label here momentarily. But the theme really in this comparison, and I think you can probably, there's the closing bell, but I think you can probably get a little bit of a feel for this without me even doing too much explanation. The theme of this entire really kind of comparison happens to be the divergence looms large. So up on top over here, we happen to have the QQQ, right? I'm going to use the ETF product. Second over here, we have the IWM. As we start to approach the bottom, this is the spiders. And last, but definitely not least, is the underperforming diamonds of the Dow. So as I said, divergence kind of looms large. What you're looking at, again, it's a comparison, all four of the major index products, and this is on, again, a year-to-date, specifically a percentage comparison. And you want to talk about some wild divergences. You have the Nasdaq up almost 12%, the Dow actually, what? Well, down about 0.6%, or shall I call it massively unchanged for the year. The spider is up negligibly on the year, and we're starting to approach, again, kind of that halfway point, and you realize in an average year, the spider is supposed to turn about 8%, maybe not including the dividends. So the fact that it's only at 2% starting to become a little bit worrisome. But everywhere you turn right now, and in terms of like asset managers and individuals that are talking about the marketplace, they're constantly talking about the rally. Is there a rally? Oh, yeah, there's the rally right here. And the small caps have even caught fire right now. And they're within, again, just breathing distance, the IWM in breathing distance, of course, of the QQQ. Now, the reason I'm bringing this up, and I say divergence looms large, first of all, you can go back for years. Go ahead, knock yourself out. You guys should actually do this stuff yourself. You are not going to see more wild divergences than what we're seeing right now. And I've been tracking this stuff for years. Literally, you're getting the spiders defecting to the downside. You've actually got the Dow defecting to the downside. Okay, the IWM is trying to pick up a little bit of steam. But again, over 3 years, a vastly different picture. Over 3 years, that is the IWM down below over here. It's just trying to pick back up steam. The Dow in the tank, all right? The S&P's falling. And then we have the unstoppable Nasdaq. But the deeper you look into this, the faster you're actually going to see the divergences actually kind of unfolding. Take this from a 3-year all the way down to 1 month. And when I say how fast the divergence is kind of, unfolding over here, in literally the last month, do you realize that the Dow is down about 1% in the last month? The S&Ps are relatively flat. They're up about 1%. And again, the divergence between the Nasdaq, which is up top over here, and what? The diamonds, you're looking at over a 6%. Okay, over a 6% divergence between the two of them. And this is where you have to stop. And if you've never looked at like relationships in trading and so forth, it's a much more kind of quantitative take in trading. This is where you really have to step back and say, okay, clearly something has got to give. All right, something has got to give. So I spent a lot of time in the last couple of days kind of, looking at relationships between one product and the other. And in this particular circumstance, I've actually discounted anything involving the bonds. So let's take the bonds out of the equation. And the reason I took the bonds out of the equation is I don't want any unnecessary FOMC interference. What it all comes down to, okay, in terms of these divergences, has everything to do with the financials, right? And we've just talked about the financials pretty much till we're blue in the face. The financials, let's put it, clear cut and simple here. They are failing right now in terms of the S&P. The financials happen to be down approximately 2%. But the interesting kind of, I guess divergence and a little bit of a dichotomy in here happens to be that the financials are down by 2%. But the IWM, which is the Russell 2000, is filled with kind of smaller financials, if you will, like small regional banks. It's up some 10%. So even within a particular sector, there's more and more divergence over here. Nevertheless, Okay, one of the important points to be made over here is specifically what sectors are causing the drag and what sectors are causing this divergence right now. And so I did some, a little bit of exploration in here. So yeah, we know that the financials are weak on a relative basis. Then I went and I looked over at the, energy sector. So looking at the XLE and like, okay, now the XLE happens to be effectively in line. This is a year-to-date percentage. It's in line with the S&Ps. Okay. And as you start to really explore, and by the way, you can go through and start pulling up different sectors and so forth. You start to explore the sectors. You start to quickly, come to the realization that the only thing literally holding the S&Ps together, people, it's not even so much the Nasdaq. It's not even so much the Nasdaq as it's all about the monsters of tech right now. Now, the monsters of tech, if you've never heard this terminology, this is something that we kind of coined here at TheoTrade. I specifically, I call them the monsters of tech. Some people will call them FANG stocks. I can't stand it. I can't do it. But the reason I call it a monsters of tech is this is a conglomerate symbol that we kind of built. And it's 5.8 times Facebook plus Apple plus a ratio of Microsoft plus Google plus Amazon. And what I want you to see in terms of the monsters of tech is their performance on a year-to-date basis. So what we've got on a year-to-date basis here happens to be the equivalency of almost 20%. Now, sadly, the market cap, again, the market cap of these 5 underlyings, and I'll even exclude Netflix right now because Netflix has gone into the, area of the absurd because it's up 100%. But I'm excluding Netflix. It's not part of the monsters of tech in kind of our equation here. But when you start looking at the monsters of tech and you're realizing they're up 20%, and you start looking at the market cap, of the monsters of tech, meaning that how much weight in terms of the Nasdaq is into Amazon, is into Google and Facebook and Apple, and the answer is it's absolutely phenomenal. You have an entire marketplace right now, the entire marketplace that's sitting literally on pins and needles because, and again, I'll go over to the Qs, I'll defer to the Qs, because, of what? 5 underlyings. It's now, we are down to these 5 underlyings where money management asset managers are actually shoving capital into them to push the Nasdaq higher. It is what I would term a form of manipulation, but there's a bit more on this front. And the reason I say there's a bit more, it's not just going on inside of the QQQ. This has been going on for a while. So we can also look over at the diamonds. The diamonds, as I said, they're for the most part unchanged on the year, down ever so slightly on the year. But let's defer again and talk about the Dow for a second so you can get a better feel of not just, okay, I get it, 5 stocks are driving the market. It's not about just 5 stocks driving the market higher. It's about underlyings that have actually defected and are literally dropping in the background, and people are not seeing that there's some really large market cap, dropping in the background, and it's being masked by the sheer magnitude of those monsters of tech. What you're looking at now in my left side bar happens to be the Dow. I just pulled up the 30 stocks of the Dow, and all I'm going to do is I'm going to sort the Dow. All right. And I'm sorting by the last price. The way the Dow works is not by market capitalization. What that effectively means is when you look over at a product, and you looked at something like the S&P 500, and you get a company that's a $500 billion market cap. That $500 billion market cap means a whole heck of a lot inside of the S&P 500. And there's a lot of those $500, billion dollar, I guess the $500 billion club and higher. And that's what the monsters of tech effectively are. That's what your Google and your Amazon, and your Facebook, all right, and your Apples all belong obviously to the $500 billion club. So they carry a fairly large weight inside of the S&P 500. More appropriately, forget about the S&P 500 for a second. Just look, at the NQ 100, which is the Nasdaq 100. When you're a $500 billion company in this group, you basically own the Nasdaq, which again, it's been driving the Nasdaq higher. But the Dow is vastly different. And that's why I want to bring you into the Dow, because the Dow is actually displaying what's really, in this case, what's really going on inside of the marketplace, which to me is highly unusual. The Dow happens to be all about, okay, all right, instead of market cap weighting, it's price weighting. It means, okay, if a stock inside of the Dow goes up $1 or down $1, okay, just a stock goes up $1, down $1, what does that equal, okay, inside the Dow? Okay, the answer is it's right around $7. So it's going to move the Dow by about 7 points if Boeing moves up or down $1. Now, the point that I commonly make with this is if you look at a product, right? And I say a product, it could be any stock. So let's look at Microsoft, and Microsoft's a $100 stock. Let's say Microsoft moved up 10 points. I think we'd all agree that if Microsoft moved up 10 points, it's a huge move, right? How big is the move? The move is 10%. But that's equivalency, okay, of about 70 Dow points. So that's equivalency of about 70 Dow points. Now, could Boeing move up or down $10? Yeah, Boeing moves $10 all the time. So Boeing does it. It's like, don't worry about it. I got it. I'm up or down $10, every other day. I mean, today was a really low range for Boeing, and it still moved, what, like $7. And that was a really low range. So it moves up or down $10, which is the equivalency of plus or minus 70 points easily inside of the Dow on a day-to-day basis. Do you see what has happened inside of the Dow is we're disproportionately weighted now into Boeing. Okay. Now, people are going to look at United Healthcare. I don't really look at United Healthcare because the volatility of United Healthcare, okay, is minuscule. In fact, even look at the range. But then you have to start to consider stocks, okay, that do have bigger ranges. Caterpillar, okay, it's kind of a wild child. It's about 30% implied volatility. But start to look at these underlyings. All right, let's first of all, this is a 9-month chart, but let's take it into a year-to-date percentage. Caterpillar's down, okay, just shy of 10% year-to-date. Let's look at Boeing. Now, Boeing, this is interesting because Boeing is still up 15% year-to-date, but just recently has now suffered a 10% decline, okay? The market cap weighting of the Dow is likely to be its undoing. So we're going to come back over here for just a second. We're going to go back over to what I call kind of my personal list, and we're going to unsort my personal list, no sorting whatsoever. And we're going to pull up the Dow, right? And again, the Dow year to date down mildly. But the point being here, it is in a major kind of downdraft here in just the last 2 weeks of trade, not even a full 2 weeks. We're down, in excess of about 3% from high to low over here. It needs to be watched very, very carefully. Why? Because it's not just the Dow. If you haven't looked, even the SPX got bid up a little bit today, but has been slipping kind of in the backdrop. Again, all of this kind of amounts to one aspect, and that is it's not, when you start looking at the Nasdaq, it is not specifically the Nasdaq holding us up, because I started looking at individual Nasdaq stocks and I started to really dig into other big market cap products, stuff like Intel. I mean, come on, take a look at Intel and year-to-date percentage. It's very similar. Interestingly enough, Intel is very similar to like Boeing on a year-to-date percentage. It was up, 24% and has actually slipped substantially, got a little bit of a bid back under it, But there are products like this all over the board that are actually slipping and slipping quickly. One of the reasons that people aren't seeing it, everything is being masked. And everything is being masked as money just flows into something like Facebook, flows into Google, And you have to look at this, the entire marketplace, as kind of an interesting game of musical chairs right now, Unfortunately, it does look like the music's about to stop. Again, I've been bearish for quite some time. But in the very short term, we've got some very serious risks facing us. Now, I'm not telling you that the marketplace can't go up, because the marketplace can always, rally, and there's always a probability of it. But right now, the fact that we literally have 5 stocks holding us together, it makes the risk reward, unfavorable. That is, if you're going to hold on to bullish positions, it's crazy. The risk of holding a bullish position, it isn't worth the upside potential, because the downside risks, have become that much more prevalent. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.